Now I have to try to live up to that introduction. I want to first say something about Jody Chamberlain, the founder of this event. I've known her for 15 years, and I'm incredibly proud to be her friend. I'm proud that she invited me to this, and I'm super proud of her for all that she's accomplished. Jody, very good job so far. Before we start this kind of quick finance lesson, I'm going to do a quick poll in the room. If I told you guys that I would give you if you gave me 30 cents, I would toss a coin, and if it was heads, you get $1. If it's tails, you get nothing. So I'm going to charge you 30 cents for a coin toss that you might win $1. How many of you would do it? Okay, so for those of you on the internet, 62.45% of the people said yes. I had a professor at Harvard Business School that told me that 87% of all statistics are made up on the fly, and that was no different. But but no, a majority of the people did say yes, and they are right, and because it's pretty intuitive, right? You know, the average of $1 and 0 is 50 cents, and if you pay 30 cents, then you kind of have this, 20 cents expected value return on that investment. So we're going to kind of dive in real quick. I'm going to do my best to cover a very complicated topic in only 20 minutes, and we'll see how it goes. So in this example, we're going to be analyzing whether or not we should buy this website, Widgets and Gadgets and More. And the website is going to make like $25,000 in profit, and the asking price is $100,000. But just so you know, you can use the same tool if you were launching a project that you thought was going to cost $100,000 to build, and you expected to make $25,000. The math is the same. So Widgets and Gadgets and More is the title. In cash flow, I'm going to say it does like $30,000 a year in revenue and $5,000 in expenses. Okay, and some of this is going to be a little weird at first, but I promise by the time I get to the end, it'll start to come together. So the first thing that this calculator is asking me to do is enter a discount rate. For those of you that don't know, a discount rate is the cost of capital. It's that whole time value of money thing that you've been hearing about your whole life. And you can put it in two buckets to simplify it. You can say, okay, well, if I'm taking money from a bank, for example, and they're charging me 8%, then 8% is my cost of capital. It's the actual cost of the money, right? But if it's your own money that's in the bank, it's whatever you consider a reasonable return on a passive investment. So I think most entrepreneurs would expect to make at least 10% on the passive investment. So we don't dwell on this point too much, I'm just going to put 10% in here, and we're going to go to the next thing. Because what we're trying to do is we're trying to figure out what is the current value of future cash flow, right? So right now, it's all future cash flow is going to be reduced by this 10% discount rate. Now here's the tricky part, and this is like the coin toss example. Where there was a 50% risk that you would going to lose the coin toss. Well, you use the same thing in business. You can try to, run all kinds of models and projections, and then you try to figure out, well, what are the chances that that's not going to happen? And of course, it's not an exact science. That's why people do worst case and best case scenarios. But, like for example, on a website, in a blog, a travel blog, or any one of those types of things, if it's a year old and it relies on just a couple keywords that it ranks for in Google to get all of its traffic, it might have a 60–70% risk factor on it. Whereas if it's 10 years old, they have their own newsletter list and Facebook and Twitter followings and everything, it might be more like a 20–25% risk. So it has a huge impact, and we're going to come back to it again, but I just want to real quick, for this Widgets, Gadgets, and More, by the way, let's say it's 10 years old and they do have a big customer database, so we're going to put a 20% risk factor on it. So, and again, on that, right, what's happened here is that the discount rate and the risk factor have gotten added together. So this 10% and 20% have gotten added together, and we have a weighted 30% risk-adjusted discount rate. So on the coin toss example, there's no discount rate because we're not going to toss the coin next year. We're going to do it immediately. So there's no time value of money on the coin toss. But there is the 50% risk, so you just have 50%, right? Okay. So in the real world, nothing stays constant. You're not going to buy a business or start a business and it makes exactly $25,000 every year. But we're going to just kind of imagine a world that doesn't exist for a second and look at it at $25,000 a year. So in this example of widgets and gadgets and more, and I know the studio audience can't see the screen that well, but so far what we have here is we have year one's cash flow of $25,000, which is the $30,000 in revenue minus $5,000 expenses, is actually only worth $19,250 today because it's been discounted by that risk-adjusted discount rate of 30%. In year two's cash flow of the same $25,000 today is worth only $14,792 because it's been discounted twice. It's 2 years out, right? And year three has been discounted 3 times by 30%. So that $25,000 3 years from now is actually only worth $11,379. So far, we have a present value of future cash flow of around $45,000. But we're not going to just shut the site down after 3 years. So where it gets a little tricky is you have to say, well, there's 3 things that can happen to cash flow. One is that it goes away, but we don't have to worry about that because we've baked it into the risk formula. The second thing that can happen to cash flow is that you have what's called a terminal event. So a terminal event is like if a venture capitalist asks you what your exit strategy is, they want to hear from you that you're going to buy their shares, take it public, or sell the company for an estimated valuation of Y after Z number of years, right? Because they're going to take those numbers and plug it into their net present value calculator and in order to decide if they're going to make the investment. So you've got to have some kind of final number for the calculator to think about. So in this example of widgets, gadgets, and more, let's first look at this like we were going to borrow money from a bank and then sell it. So, for example, if I walked into a bank and I said, Mr. Banker, loan me $100,000 to buy widgets and gadgets and more. I'll give you 10% interest. And I think there's a 20% chance my plan's going to fail. But what my plan is to cash flow it for 3 years and then try to sell it for $150,000. Well, if that was my plan, I would fill out this calculator exactly this way. And what happens is this $150,000, which basically happens in year 4, is only worth $52,000 today because it's been discounted 4 times. So if you add together the terminal value of saying 4 years from now I'm going to sell it, and plus the value of the cash flow, you get a present value of future cash flow of $97,921, meaning that the net present value, and again, I know it's hard to see here, but the net present value of the deal would be negative $2,700. In other words, if I paid $100,000 cash for a business that was making 25 grand a year, that I put a 10% discount rate on and had a 20% risk factor on, I am destroying $2,700 worth of wealth. All right? But that's based on those numbers. And I can show you how that's could change drastically real quick. But before I show you how the risk changes it, I want to show you the third thing that can happen to cash flow. The third thing that can happen is that it just continues to show up. So maybe you buy something that just makes $25,000 a year forever, and it has no terminal event. Well, for that, the math gods gave us a very simple formula. It's called the perpetuity formula. And it tells you what cash flow is worth in perpetuity. It's super simple math. It's the cash flow divided by the discount rate. Everybody should write it down. Cash flow divided by the discount rate. This formula is revolutionary. So $1,000 divided by a 10% discount rate would be $1,000 divided by 0.1 or $10,000. Ignore the calculator. I typed that in wrong, but trust me, that's what it is. Yeah, $1,000 divided by 0.1, $10,000. So here what's happening is we have $25,000 a year divided by a risk-adjusted discount rate of 30%. So 25,000 divided by 0.3 equals 800 or $83,333. Or of course, I could just check this box keep on the web page and it'll do the math for you. So based on the perpetuity formula, if we were to pay $100,000 for this, we would be destroying $16,666 worth of wealth because the present value future cash flow would only be $83,000. So like I tell my guys, you can get a quick and dirty value of almost any business by walking into the room, saying, what do you do? How much does it make? Okay, get a quick estimation of how much you think the risk is, divide what it makes by what the risk is, and you get a rough value. And you could spend weeks and months with spreadsheets tweaking that and getting it right, but you're going to ballpark it really quickly by just dividing the cash flow by the risk and the time value of money. How profound these discount rates are, this same, and let me see if I can make this a little bit bigger for the audience. This same, made that a little too big. What the heck happened here? This same discount rate, these same cash flow numbers, sorry, at a discount rate of 10% would suddenly be a winner. At 10%, the first year's cash flow is worth 20 grand, the second's worth 17, the third's worth 14, so at a 10% risk, the present value future cash flow in this business is now worth $125,000. So if I paid 100 grand for it, I'd be creating $25,000 worth of wealth before it's even happened. And that's what finance people do at large companies, is they try to break everything down to just this net present value formula. If it's a positive number, you green light the project. If it's a negative number, you red light the project. Because you're either creating wealth or you're destroying wealth. Governments use it when they're deciding whether or not to dig some new deep water port. I mean, you can use it for literally anything. How much time do I have left? A few more, I got time. Okay, so I'm gonna real quick cover a couple of questions that I get a lot. A lot of times when I'm talking to customers with internet companies they want to sell, they'll ask me, well, what about the value of all my software code that I've done? What about the value of all my content, all the pictures I've taken, all the, this, that, and the other? My answer to them is that everything you own goes into either the asset column of your balance sheet or liability column of your balance sheet. And if it can't be sold for cash, it's not an asset. So you're not exactly going to be able to sell off the content, sell off the code. You're certainly not going to be able to do it easy. Those things certainly aren't liquid. You'd have to start a whole new business just to sell off the content and the code. So if you can't turn it into cash, then it adds no value to the sales price because the content you have is already baked into the revenue that content is generating. Now, if you're McDonald's and you own a bunch of real estate on the corner of Main and Main, and you have no mortgage on those things, that's different because that real estate could be sold and the business could continue to operate. So basically the money you spent to develop your website is a sunk cost. It's never coming back. It's been put in a wooden ship, put out to sea, hit with arrows on fire. It's gone. So another question I get asked a lot, and this is a good one. So someone will tell me, well, Rick, what happens? I've got this new product that I'm working on, and if it comes out, it's going to be gangbusters. My revenue is going to double every single year. So why should I sell it at only this price? Or tell me what it's worth based on me thinking that it's going to make that kind of money. I welcome that question. So let's look at the math. So let's say that you're going to buy widgets and gadgets and more, and that you were going to double the revenue every year. So now you would come over the same calculator, and I'm on year 2, for the revenue, I'm going to put $60,000, and on expenses of $10,000, so we'll double that also. And then on year 3, I'm going to put $120,000 in revenue on expenses of $20,000. So there we go. We just doubled everything year over year. So now when you look at this calculator, you see that the present value of future cash flow is $402,000. So if I pay $100,000 for this site, I'm creating $300,000 worth of wealth. The problem is that if you're going to say that you're going to double the revenue every year, you have to adjust the risk. Right now, I still have that risk at 10%. The reality is, any investor looking at this thing would say, well, if your plan is to double the revenue every year, then you need to put a 75% risk on the whole thing. And if we come up here and we change that same risk to 70%, now we've got a present value of future cash flow of $67,901. So you would be losing $30-something thousand if you invested $100 grand in it. So that's why if you ever talk to a venture capitalist or an angel investor, they want to hear that you're going to grow your business 1,000 or 10,000 times the size, because the risk will destroy any gains if you're only planning on doubling it or tripling it. That's about all I got. Thank you, everyone, for your time.